Hi, and thank you for joining us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of working for yourself, being self-employed, running a small business. Today, we're going to take a look at pensions from an accounting and tax perspective. Something that we've been asked a lot about as we're approaching the end of the tax year. Before I talk about that, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you will easily be able to refer back to this information if you need to, as well as being able to find other information that we have available on a whole host of different topics, all aimed at supporting you in your self-employment. If you find the content helpful, please do take a moment to like the video. That helps us understand which topics are the most helpful for people and which to concentrate the answers to your questions on. So back then to pensions. So just to be clear, we're talking about pension contributions from both an accounting perspective and a tax perspective in regards to the contributions made. So we won't be talking about any advice with regard to pensions. If you do need advice for pensions, then you should contact an independent financial advisor who is regulated and fully qualified to advise on pensions. So as I mentioned, we're going to look simply at how you account for the contributions coming out and what impact it has on your tax, the contributions. So the first thing to mention is one big difference is whether you're operating as a sole trader or a limited company. If you're operating as a limited company, then whether your company are making the contributions or you personally are making the contributions. So if you are a sole trader, you will remember that you and the business are in effect the same entity. So therefore, your contributions to your personal pension scheme, if you are a sole trader, are always going to be personal contributions. They're never going to be an expense of the business. So when you're accounting for money that you take out of your business account and put into your personal pension scheme, that is always going to be drawings. Unless, of course, it's done through the payroll, but that's a different topic. Today, we're just simply talking about personal contributions that you make directly into your pension scheme. So if you are a sole trader, then the pension contributions are not going to be a business expense. So they won't reduce your profit. But you will get tax relief, and we'll come on to that in a few moments. If you are trading as a limited company, if the company is making the payments to your pension, then directly from the company bank account, then you will remember that the company is a separate entity to yourself. So in this instance, the contribution to the pension are a direct cost of the company, so they will reduce the profit for corporation tax purposes. But then beyond that, they won't have any impact on your personal tax. So going back to if you're a sole trader, or if you're a limited company, but it's not the company making the contributions, i.e. you've had money out of your company into your personal account, and then that money has gone into a personal pension, then that will count as you personally making the contributions. So in these instances, how the tax relief works is when you put the money into your pension initially, you are automatically given a credit that's equivalent to the 20% deduction. So therefore, assuming that you would have paid 20% tax, and therefore when the money you pay into the pension goes into the pension, the tax that you would already have paid gets added on. So you get, in effect, if you made a payment into your pension of say £80, then it actually £100 would be credited to your pension, which would have been that amount before 20% tax was deducted. So that's how you get your standard rate tax relief. So it's as if you had the money, if the money went into your pension before you were taxed on it. But then the next question that I can hear you asking, if you are into high rate tax threshold and paying tax at 40%, then the system that I just described means that you're only getting tax relief at 20%. So to give you the full relief on the full 40%, what happens is at the end of the tax year, it will be important to make sure that HMRC know how much you personally paid into a pension scheme throughout the tax year, and then your threshold will be adjusted accordingly. So it will be increased so that the amount that you paid into the pension is added on to the amount you pay 20% at. So let's say, for example, let's round the high rate tax threshold to 50,000. And so ordinarily that is the point, as soon as your income goes over 50,000, anything over 50,000, you will pay 40% tax on. But let's imagine that throughout the tax year, you were either operating as a sole trader or a limited company, but it wasn't, the contributions weren't made as a company expense. They weren't made through the company, you made them personally. Then in this example, if you paid, say, £5,000 contributions, then your high rate threshold would be increased to 55,000. So therefore, the £5,000 of contributions you made, you're now only going to be paying 20% tax on there. Therefore, you have got full tax relief on that. So going back, if you're a micro entity, if you're operating as a micro entity, a limited company, and you are making and that your company is making your pension contributions, then therefore it will reduce the profit of the company and therefore it will reduce the profit for corporation tax purposes. Therefore, effectively, you won't pay corporation tax on that amount. And as this isn't a personal contribution, it would have no impact on your personal tax. So it can be a little bit confusing, but once you take the time to think about which your situation is and then how the contributions have been made, then you can see that it becomes easier to understand. So from an accounting perspective, if you've paid the contributions from your business account, if you're a limited company, those contributions will be an expense of the company. So therefore, they will be expensed in your profit and loss. So you will likely, if you're using Making Tax Digital software, already have a category set up for director's pension, and that will be where you will allocate those for any other purposes. If you're a sole trader and you've made the pension contributions from your business account, then this will simply be drawings because that will be personal money, and the tax relief will be dealt with on your tax return. So that's the accounting way, and that is how we're if you can sort of try and think in the language of how you've made the contributions and whether it's a company expense or whether it's personal contributions. So whether your company has paid or whether you're not a company and a sole trader, and you have paid from your own personal money, then it's personal contributions. And so if it's a company expense, then the tax relief comes from reducing the profit from corporation tax. And then, of course, it's the money's also gone into your personal pension fund. So it's left the company. It's that money's no longer owned by the company. It's now in your personal pension, and there's no tax for you to pay on that money coming out. So you can see, therefore, you've had full tax relief that way. If it's personal contributions, so as a sole trader, or you've paid your own money into a pension, even if you're an employee and you've paid your own money into a pension scheme, then the tax relief would come via your tax return. So the 20% relief, if you're a standard rate taxpayer, would be applied automatically when you make the payment. If you're a 40% taxpayer, then it's really important that HMRC are aware in a tax year how much you paid for personal contributions into a pension. So hopefully this gives you a little bit of an overview on how to account for pension contributions made from your business, and how you get tax relief, and that important thing that if it's personal contributions, to make sure that HMRC are aware to make sure you get the full tax relief. If you are a standard rate taxpayer and you don't go into high rate tax, then still it's good practice to make sure HMRC have all of the information, but it won't impact your tax because you already have had the 20%. And as I mentioned earlier, we're just talking about the pension contributions from an accounting and a tax relief perspective. So there are other factors. You will need to make sure that your pension scheme is a qualifying pension scheme, that you're adhering to the limits of how much you can pay into your pension. And as I mentioned earlier, if you do need some advice on that, then you should take that from somebody qualified to give pension advice. And of course, as we always say, if you are going to somebody for advice, please do make sure that they're fully qualified for the advice that they are giving you, and that they are regulated in the instance of pensions. So hopefully this helps. I appreciate it is a complex situation. But as I say, the first thing comes to be thinking, who is actually making the pension contributions, your company or you personally? So when I say you personally, that means that you've had the money from whatever sources, and now you're putting your own money out of your own bank account into your pension scheme. Or if you're a sole trader and it's gone from the business, that still counts as your own bank account for this purposes, because as a sole trader, you and the business are the same. So thank you very much for watching. Thank you. Goodbye.